The aim of this session is to understand how to embed top-down scenarios into investment processes, gain insights into how pension funds or their service providers are using top-down scenario approaches in investment strategies, and identify practical actions that you can take away from this session. This session is designed for the global pension community, whether you are a chair or a trustee of a pension scheme, you work within the management side, you're an asset manager, investment consultant, and all the others in between. So welcome. This particular webinar builds on the series we have done specifically on decision useful scenarios. And we have been exploring in previous sessions, we've been exploring the shortfalls of using only a bottom-up scenario analysis approach, just using a linear average temperature trajectory, and the critical elements that can be missed, like physical climate risks, tipping points, and the complex ways that political, economic, and behavioural responses interact. We have run a series of these, including sessions introducing the narrative scenario analysis approach and how it can help address some of these challenges. And at the end of this session, we will provide a link to our web pages, where you can find the recordings of our previous webinars, which talks more about that. The focus of this session is to dive deeper into using multiple scenario approaches to complement those bottom-up scenario approaches in order to better reflect real-world complexity and strengthen risk management. And to understand what this means in practice and how it can support more resilient investment strategies, we are delighted to welcome a panel of experts who will bring experience into this particular topic. And we're going to start with a keynote from Mirko Cardinale, who is Head of Investment Strategy at the investment arm of Universities Superannuation Scheme, USS, who, alongside the University of Exeter, published their new climate scenario approach in 2023, with the aim to be able to better reflect these real-world risks and opportunities. And we have been tracking their process as they embedded the narrative approach into their strategic asset allocation and investment processes. This approach has been used for the last TCFD reporting cycle, and Mirko will take us through what this approach has told them and what they did with this analysis afterwards. We will then open into a panel and end with a Q&A session where you will have time to ask any questions you may have. We will be recording the keynote and panel section of this session, not the Q&A section, and we'll post on our website in due course alongside the other deep dive webinar recordings. And for the Q&A session, we encourage you to be on camera and show your name and organisation if you can. But before I start recording and hand over to Mirko, we have a couple of poll questions to help gauge where people are. So Olivia is going to share these questions. We have 5 short questions for you. So starting with the first, how do you use climate-related scenario analysis in your investment decision-making processes? Please pick the one that is most relevant there. Primarily used for reporting, used to inform strategic asset allocation, in day-to-day investment decisions, across multiple functions, not sure, or we don't currently use climate-related scenario analysis. What is the primary time horizon of your climate scenario analysis? And then how confident are you that your current scenario analysis process enables you to understand the full range of climate-related systemic risks your fund or your client's fund may face, depending on what organisation you are representing here. And then question 4, what do you see as the main barriers to understanding the full range of systemic risks? And we've listed a few here, but there may be some other ones there. And then connected to this, question 5, how important is it for financial regulators to have clearly defined and highlighted the systemic risks for financial institutions? So if we are ready now to see those results, Olivia? Fantastic. I'm just going to scroll up. Yes, so as essentially predicted, the primarily used for reporting compliance. I think this is quite a common one, but encouraging to see that some are using this to inform strategic asset allocation. It'd be interesting if one of the panelists would be able to relate to or to point out on the fact that no one mentioned used across multiple functions. So maybe there might be some examples that we could bring out there. And then on question 2, what is the primary time horizon of your climate scenario analysis? Again, the beyond 20 years is as anticipated, assuming that most people are using the bottom-up approach at the moment. How confident are you? Not very confident, not at all confident. Well, you're in the right place. We hopefully will help you with that. Number 4, what do you see as the main barriers? So quite reasonably spread here. Lack of credible scenarios, unclear of how to use the results. So this webinar, sorry, is particularly to focus on the what next, what to do with the results. And then number 5, how important is it for financial regulations? This is a really interesting one, bearing in mind we have such a difference here, very important and not important, not sure. So I think this kind of clearly outlines the challenge that both the markets and the financial regulators face when there is very difference of opinion about what is needed or expected from the regulators and what isn't. Okay, so enough of me. I'm going to pass over to Mirko, who's going to present to us on using narrative scenarios to inform USS's investments. Enjoy.
Thank you very much, Kerry, Olivia, and the A4S team. I'm delighted to be here to share some of our experience over the last few years on climate scenario analysis. So, as Kerry said, I'm Mirko Cardinale. I'm head of investment strategy at USS, or actually USIM, the investment arm of USS, which is the largest private sector pension scheme in the UK. We manage around 75 billion pounds, and we have a large in-house investment team. My team's responsibility is strategic asset allocation and total portfolio management. So we really look after not just the strategy design, but also the day-to-day management of the fund's assets. Also, what I'd like to share today is our journey, starting with our first experience in the climate scenario analysis, and really ending with our most recent application of scenario analysis, what we disclosed in our TCFD report over the summer, and also what we're planning to do going forward. So if we start actually from our first slide, this is our starting point back in 2022. As we've seen from the answers to the poll, most of us at least started to think about scenario analysis from a regulatory compliance perspective, and this was no exception to USS. Climate scenario disclosure was made mandatory in the UK, taking on board the recommendation of the task force, climate financial disclosure, or TCFD. So in 2022, we embarked on our first attempt to run climate scenarios, and we partnered with Ortec Finance after reviewing a range of different providers. And actually, the most interesting aspect of that experience was really the debate that the analysis and the result had sparked with our internal governance bodies, the investment committees, and the executives. We clearly focused in our debate on the limitations of the analysis. We highlighted some important ones, and also which really became the starting point for us to explore how we could improve. And so the main limitations were essentially 3. The first one is the treatment of physical risk. So physical risk was really looked at using highly simplified relationships between temperature and GDP, rather than actually understanding the likelihood of hazards or different type of hazards in different locations, and thinking about also the near-term perspective. It was very much thinking, focusing on the long-term pathway and the relationship with GDP. So that was the first one. The second one is that climate scenarios were looked at in isolation. They're not really integrated into everything else that is happening in the world. So technology cycles, boom and bust potential market cycles, or really the geopolitical development. So everything we know actually driving macro and market outcomes over the medium and the long term as well. So that was another important shortcoming. And the third one was really the focus on very long run horizons, which really, in our view, compounded the uncertainty. And so when it came to interpreting the results, we actually debated at length about the meaning of the difference in expected return between different scenarios and different pathways. This is shown in the table. The gap between the most pessimistic and the most optimistic scenario was about 70 basis points in terms of the long-run expected return. And we actually concluded that it's probably unhelpful to focus on those numbers, because those numbers hide a huge amount of uncertainty that the scenario analysis really is not able to address, or is not able to do proper justice, especially over such a long time frame. So this was a starting point for us to explore a new approach. And this is essentially what we've done with the publication of No Time to Lose in 2023. Initially, this started as a casual conversation. I was introduced to Tim Lenton, who was a leading climate scientist and expert in tipping points from the University of Exeter. And we started exploring initially how we could better integrate the scientific perspective on tipping points and really the likelihood of a physical hazard into the analysis. But we then concluded that actually we wanted to take a more holistic approach and rethink the whole framework for scenario analysis. And this is essentially what we've done. If we move to the next slide, we assembled a working group with the help of University of Exeter, of experts across a number of fields. So climate science, as with Tim Lenton, as I mentioned. We had Mark Cliff, who is a leading economist, former ING. We had pension experts. And beyond the actual project working group, we actually reached out to more than 40 experts in different policy areas and experts in different fields. So really, that created a rich set of information that we then apply to actually develop an entirely new approach. And the new approach was really centered around narrative scenarios. And narrative scenarios for us is really about starting from a write-up, a narrative of how the energy transition might unfold over the next few years, against the backdrop of the increasing risk from climate-related natural disasters. So this is really trying to write down, rather than starting with quantification, which tends to be the approach of traditional models. Start with a narrative, and we built a framework to understand the key levers, the key dimensions that we can then use to write down the narratives. The two dimensions we identified to build our scenario framework were the policy focus and coordination on the one hand. So to what extent action to deal with the climate challenge and prioritize the energy transition is going to be focus for policy on the one hand. On the other, the speed of technological development and the dynamism of the private sector. So, and this really created a neat framework to help us identify 4 alternative scenarios. We deliberately focus on the near term, and we define the near term as 2030 or 5 to 7 year horizon. And 2030 actually, we think, is an important milestone because we will know by 2030 whether we are on the right track towards the 2050 ambition of the Paris Agreement. But we think we took the view that it's better to outline the narrative and focus on near term rather than start from an assumption on the pathway. So we almost reverse engineer the approach of traditional scenario analysis. And because we focus on the near term, we explicitly incorporated everything else that is happening in the world. We macro cycles, political developments, technology, etc. And that really made the narratives much richer than what we see from a traditional scenario analysis. And physical risk and the perspective of climate science was explicitly integrated. And one of the important conclusions from the report is essentially physical risk over the near term are almost baked in. You don't really need to make an assumption on the long-term climate pathway to understand the near-term physical risks. They are almost independent of the scenarios and what you assume on the energy transition in the near term. So this was the analysis underpinning the No Time to Lose report that we published jointly with the University of Exeter in 2023. And that obviously wasn't the end. That really was the starting point for us to embrace this new framework and then develop an approach to integrate that into our investment decision making. So if we move to the next slide, I will give you some highlights of how we've then taken the narratives and modeled them using a macro econometric framework. We've used the E3ME model run by a company called Cambridge Econometrics, which is really a non-equilibrium model that enables us to analyze how the economy and the energy system might respond to different policies. So you need to make a lot of assumptions on policy, on technology, and you end up with a set of outputs which look at macro variables, but also the energy system. And this is a snapshot of this is what we published in our recent TCFD report in 25, which gives a flavor of how we then take in the scenarios and derive some implications. If you look at the chart, the top right chart, what the analysis shows is actually a huge amount of dispersion in terms of near-term potential outcomes for global growth. So the scenarios point into very different direction. And this is actually becomes then a challenge as to how you integrate that degree of uncertainty into your investment decision making. But the uncertainty is basically as large as maybe at the bottom end of the spectrum, you could imagine a negative global growth outlook, almost a repetition of what we have seen over the global financial crisis, or actually even worse than that, because the outcome on growth might actually be worse if we include China. At the upper end of the spectrum, you can actually add almost like a productivity-led boom, similar to the late 90s. So a very wide spectrum of outcomes, which is certainly something you wouldn't find using more traditional models that have very smooth pathways in terms of near-term GDP growth. On inflation, actually, interestingly, we found that inflationary pressures are present across all the scenarios through a combination of physical risks, geopolitical tensions, and so the rewiring of supply chains, and the challenges of the energy transition. So actually, the scenarios point towards volatile and higher inflation than what we've been used to in the post-GFC decade. If you turn to the next slide, this is a snapshot of what the model actually told us about the energy mix, and this is as we know, there are limitations when you convert narratives into a modeling framework, and when you interpret the result, you always have to be very much aware of that. And these results spark quite a lot of discussion internally with executive, with portfolio managers and analysts. But essentially, what the model tells us is that even the most optimistic scenario, which we call Roaring Twenties, where the stars are aligned, policy prioritize the energy transition, and technology develop fast, scenario that arguably doesn't look very likely at the moment. But even under that scenario, the reduction in the global carbon emissions by 2030 appears to fall short of what would be required for a 1.5 goal and sort of net zero by 2050, which I think we thought was an interesting result in itself, because of course that's the most optimistic scenario. If you look at all of the other scenarios, the path of carbon emission reduction is even lower. But the second, on the sort of more positive, on a more positive note for the energy transition, the scenarios point towards a reduction in global oil demand. And this is robust across the different scenarios. The drivers of that reduction are different. In some scenarios, it is weak global growth driving a reduction in oil demand. In other scenarios, is the speed of development, and on the technology side, the electrification, this growth of EVs in China, etc. And this is highly controversial results. It is very different from the industry assumptions, and even some of our analysts disagree with it. But we thought it's very interesting in terms of sparking a debate and really helping us challenge some of the industry assumptions, and we almost using this as a stress test when we speak to company management, or we think about macro implications, commodity prices, etc. We found it extremely valuable. If we move to the next slide, we also focused. So besides modeling the transition, we also focus on modeling near-term physical risks. And as I mentioned, the framework that we laid out in No Time to Lose actually shows that physical risks are baked in, are independent of the transition assumptions, or largely dependent on the transition assumptions in the near term. So the priority for us on physical risk was to work with the climate scientists to understand how different regions and different countries in the world are exposed to climate-related hazards, and to what extent they are able to cope with them. So looking at the probability, the potential damages from the hazard, and the called the readiness scores, to the extent to which they are able to respond to those. And this is a snapshot of a heat map that we showed in our DCFD reports, with the UK appears to be relatively less exposed in the near term to many hazards, but flooding is a significant concern. This is something that needs to be taken account when looking at specific assets in the UK. The US has a very interesting pattern, very different across regions, but some parts of the US are very exposed to climate risks. And we've seen the insurance industry withdrawing from certain locations in the US, which very much confirms this. We found exposure to climate risk very significant in China, or at least part of China. And also we found emerging countries, some emerging countries, very vulnerable to climate risk, wildfires, heat waves, and also some of those countries have the least ability to withstand those. So clearly, when looking at emerging markets, this becomes an important factor to consider when thinking about exposures across emerging countries, being Southeast Asia, Latin America, etc. So this gives you hopefully an idea of the type of analysis that we've done and how we derive implications. Now, in the next slide, I'll try to give you a sense of how we then integrate this into our investment decision-making process. I should say that to properly integrate narrative scenario into investment decision-making process, you need a framework which blends quantitative analysis with a layer of judgment. It is very, very difficult to integrate narrative scenarios, even if you are able to model them, into a purely quantitative framework, which tend to rely on capital market assumptions and optimization. So we have built a strategic asset allocation framework, which has a layer of quantitative analysis to help us filter alternative portfolios that meet basic requirements, but we then apply a layer of judgment when it comes to comparing different options into different asset allocation that sort of all meeting the basic requirements. And so that helps us give us more flexibility to really integrate the output, the rich output from the approach that we've taken on scenarios. So some of the themes that came out and that really we were able to integrate in our top-down portfolio allocations are listed here. First, as I mentioned, the macro analysis suggests that we are likely to be in a regime of higher than average and more volatile inflation, certainly compared to the decade of the 2010s. So that suggested that we should increase our exposure to assets providing inflation protection, and we have done that in a number of ways through inflation-linked bonds, through inflation derivatives, and to assets in our private markets program, which are effectively give exposure to inflation-linked cash flows. So that is a direct implication from the scenario analysis. Also, as I mentioned, the analysis points to a wide range of outcomes for GDP growth. Now, this is harder to integrate into an investment framework, but this suggests to us that it is very difficult to really try to anticipate where you're likely to be in that distribution of outcomes. But the best thing to do is to ensure your portfolio is sufficiently diversified and sufficiently resilient to alternative outcomes. And this is really helping us develop our thinking in terms of what are we looking for from our exposure to what we call growth assets, equity-like assets. And this really points us towards a more active approach. The passive market cap portfolio, we think, might not be very robust to this alternative scenario. It's highly concentrated in terms of names, sector, and countries. A more balanced portfolio is preferable, but a balanced portfolio that strikes the balance between companies with more resilient cash flows that can sort of preserve value even in the more negative scenarios, as well as companies that can benefit from, say, technology-led innovation and a high productivity growth environment. So having the right balance between those through an active approach, we think is preferable than using passive, their exclusive rely on passive market cap. And the third implication is that the scenarios really point towards the likelihood of boom and bust type of outcome. One scenario is explicitly focused on that, but even in the other scenario, there is volatility in macro and financial markets assets. Now, again, it is very difficult. We have a team focusing on dynamic asset allocation. They'll try to do that, but it's very difficult to pinpoint exactly when the cycle is going to turn. What you can do is ensuring that your portfolio is sufficiently resilient and sufficiently flexible so that you are able to, first avoid being a forced seller or having to adjust your asset allocation in a pro-cyclical fashion, or effectively selling equities after they've sold off by 20 or 30%. That's obviously the basics. But ideally, you also want to be in a position to adjust your asset allocation and take advantage of opportunity when there are large correction in dislocation. So our focus, our implication there is that we have to strengthen our understanding of how the portfolio might behave during severe market shocks. We looked at a combination of equity and bond shocks, particularly important for an asset liability investor like USS, and ensuring that we have sufficient resilience and sufficient flexibility to withstand and be able to reposition during if such market shock were to occur. So that hopefully gives you a flavor of the type of implication that we derive from the analysis. And lastly, I'd like to touch on the next steps. This is still work in progress. We think there's still a lot of work to do in this space, and I highlighted a few areas where we are still developing our thinking. We want to come back to the scenario narratives. We don't want narratives to become stale. Also, what we're trying to do is to explicitly bring together the energy transition, geopolitics, and technology. We're working on scenarios that are specific on technology, on AI deployment, and scenarios that are purely focused on geopolitics, the Trump policy agenda, etc. And now we want to bring all these strands of work together to give us an integrated framework to really help us understand what might happen over the next 5 to 10 years when we bring together all of these different macro drivers. We are also working to understand how the transition scenarios are going to affect specific companies. So going from the macro to the company level analysis through the same lens. And ultimately, the objective is to come up with a consistent top-down, bottom-up investment process where we are able to look at the implication of scenarios from a top-down perspective, which similar to what I showed in the previous slide, but we're also able to use the same scenarios when we look at specific companies, we speak to company management, we think about the investment case for companies, etc. And then the final area that we're working on is applying technology, and we're working with an AI tool to help us make sense of the noise in terms of all of the news flows, all of the data releases, and try to link that back to the scenario narratives to help us understand what's becoming more or less likely in real time. And if you do this kind of analysis, at the moment you'll certainly say the Roaring 20, very optimistic, all-star line scenario is quite unlikely, but there are mixed signals. So on the technology side, there are some positive signals. On the policy front, actually quite negative one. So some of the middle scenario, the scenario in the middle, are actually becoming more likely. So that's the type of analysis that we want to develop. This is still very much work in progress. And so hopefully that gave you a bit of an overview. I'm sure we'll have Q&A later. So if there are specific questions, I'll be happy to take them and can expand on the process, the outcomes, etc. Hope that was useful.
Fantastic, Mirko, and I'm sure it was. And we'll see with the questions that come through. So we're going to joining you now, Mirko, on the virtual stage. I'd like to welcome Christopher Wright, who is Head of ESG Risk and Norges Bank Investment Management, and Caroline Cook, Head of Climate. We will run this panel for around 40-45 minutes, and will be followed by Q&A session. So please do gather your questions you may want to ask. So I'm going to go straight in. Christopher, starting with you, managing the largest sovereign wealth fund now, how have you used scenario analysis to date, and why have you introduced bespoke alternatives? Maybe start with a quick introduction to who you are and who your organisation is.
Yeah, absolutely. Thank you for this invitation and the opportunity to present. So I'm Christopher Wright. I lead a team called ESG Risk Monitoring in the risk department of NBIM, Norges Bank Investment Management. So we manage the Norwegian sovereign fund. And part of my remit is to measure climate risk using different methods and then communicate those results internally and externally. So just as a context to this work, the fund has a financial goal. We closely follow a market-weighted index. We're mostly listed equity investor, one of the world's largest, and we mostly invest in listed assets. We have a fairly simple asset class mix. We're also committed to being a responsible investor. But we view climate change as a financial risk to the fund, absolutely. And this is borne out in the different models and results. And so therefore well within the remit of the fund as a financial investor. So I want to say 3 years ago, we got a new mandate to look at climate risk, and this was underpinned by a government commission, an expert group that looked at climate risk in the context of large global or funds that essentially follow a global market weighted index. And they concluded that climate risk is not systematically mispriced, but it's not systematically priced either. So there's some mispricing in the market that we can take advantage of, and that is also a risk to us. The fund would also benefit from an orderly transition, meaning the cost of transitioning is lower than the future cost of physical climate change. And having a diversified portfolio remains the best available risk hedge. So that's along the lines of what Mirko said, is that we can expect a wide variety of effects of climate change across markets and sectors. And there's a lot of uncertainty about timing and frequency of shocks. So the best you can do at this point, given the data we have, is to hold a global diversified portfolio. But we should do climate stress testing, and indeed that's what we do. So just to go a little deeper into your question about our tools. So we started this 5 years ago. We bought an off-the-shelf climate value at risk model from a vendor and applied it to our portfolio. And we've run that for the last 5 years. And we term this kind of a bottom-up approach to estimating losses. And this is based on using on a company lens, right? So you estimate damages at company level, and you aggregate these up to portfolio level. So we use this to figure out the significance of financial risk associated with climate change. So I will focus on physical risk aligned with what Mirko mentioned. So any model is necessarily a gross simplification of how climate may impact our returns. There's no single truth. We have to use different approaches and different models. And so we've always been cautious in when these models generate results. And we know that you can't even talk about precision because it's all forecasts into the future in a risk that is extremely complex with lots of uncertainty. So what we do is we compare results from different approaches. So let me start with the bottom-up approach. So this centered around estimating damages by asset location, so the assets of companies. And then you look at the revenues tied to those assets. And then you look at direct damages associated with climate change inflicted on those assets. And you can then aggregate up to company level by aggregating damages at asset level to companies, and then further up to portfolio level. So we receive, so they're based on estimates across different climate hazards that our vendor collects from NGFS and its own work. And then basically the data is expressed as a percentage of each company's market value for a given scenario, and the percentage of damages. So we run attribution of this over time so we can identify what the changes over time can be attributed to. So this type of approach recognizes that the geographic exposure of a company, so where it operates, where its assets are, is a significant determinant of climate value at risk. That's intuitive. If you have assets concentrated in flood areas, for example, you're more likely to be damaged by flooding than assets outside of flooded areas. So they're good at capturing the characteristics of individual companies and portfolios, but the limitations are also well known and recognized. In particular, a lot of the indirect effects of climate change on the economy are left out, but these can be significant. So while they work well for companies with, say, a few number of fixed independent assets with very transparent revenue streams, like a steel company with 5 steel plants in certain locations, with nearby kind of supply chains, they work less well for decentralized businesses with very complex supply chains and where revenue streams might be linked to services, right? Where you are highly dependent on assets out of your control. Indeed, many companies depend on assets that they don't own or operate themselves. Think of a factory that runs on energy supplied by a power plant, or an office building, for example, or water for crop irrigation. So these are not necessarily assets that these companies own or operate, but they are highly dependent on them. So when infrastructure fails, obviously it has ripple effects across the economy, and this is not captured well in these bottom-up approaches. So we know that there are macroeconomic factors that influence the revenue streams of companies and the expected cash flow of companies. Changes to supply and demand, economic productivity, inflation, changes to insurance markets, all of them impact future expectations of revenues. There's a lot of complexity and uncertainty, of course, in measuring this, but we know that there's something left out. So that's why we started developing a top-down approach last year to provide context for the figures that the loss estimates generated by the bottom-up model. So we have two approaches. I want to mention them in brief. The first one is very simple. It seeks to estimate the impacts of physical climate risk on our US equities portfolio. We use public sources of information and inputs from an internal financial model. So first, we estimate the impact of climate change on GDP growth. So instead of starting with the company and estimating the damages associated with companies, we look at national level growth. So we started with the NGFS Phase 5 scenarios developed by central banks and supervisors. It's important for us to anchor our approach to international standards in order to ensure comparability and transparency. We chose the current policy scenario as a starting point, so that's up to roughly 3 degrees warming Celsius by 2100, and a time frame to 2080, which corresponded to the time frame of our bottom-up approach to capture, and this obviously captures the long-term effects of physical risk, which are likely to be greater after 2050. And then we compared this to a baseline of no economic impact of climate change for the sake of simplicity. So how do we get from climate to GDP to equity prices? So if you look at GDP growth rates, there is not a one-to-one relationship with equity markets. So this is where our financial model comes in. So we have a model that we use for stress testing in other areas, in other risks. And this has components such as risk-free rates, risk premia, and dividend growth rates. So in the results that we disclosed earlier this year, we basically calculated a damage-adjusted scenario for dividend growth and a scenario with no climate damage adjustment. And the delta is essentially the result. So we arrive at cumulative damages until 2080, and then we discount that back to the present value. So what we found was for US equities, the average expected loss, so the 50th percentile, was 19% under a current policy scenario. In comparison, we ran the same climate scenario and the same market, so US equities, using the bottom-up approach where we got to 2%. So there's a significant spread in the two approaches. And as I said initially, there's no one that's correct or not, but you have to then analyze it, try to explain what accounts for the spread, and based on what we know is included in each model and what we think is the significance of that. So we believe basically that the estimation of chronic risk-related losses in the top-down approach includes a wider range of economic impacts and is therefore more credible. But we actually think that the physical climate risk is likely underestimated in both models. There's a lot that is not captured by these models that we know are important. So for example, I could say neither, in this case, no spillover effects between the US and other markets are accounted for. So let's say the US market is highly dependent on imports from other countries that will be affected by climate change. That effect is not captured in these models. There's no account for changes in market risk perceptions over this very long time period, or changes to monetary policy. You would expect there to be a feedback effect as risks get worse. There's no climate adaptation either, if you think about the upside here. So those are important omissions. And then, of course, there's an ongoing discussion about the scientific robustness of the damage function that underpins the NGFS Phase 5 scenarios, which we're looking into how the errors identified in this paper might affect our analysis. Okay, so this is kind of the summary of these two. I think I'll leave it there, Carrie.
Fantastic, Christopher. And lots to unpack, and I think we'll come back to questions in a minute to cover the then so what and how do you address some of those omissions as well. But just before I move on to Caroline, Mirko, from what you've heard Christopher explain how Norges Bank do this, do you see similar characteristics to the approach you are using? Are there differences, similarities between your approach and theirs?
There are similarities and differences, and of course, there's always something interesting to learn when I hear about how other people are sort of grappling with the same problems. So I think one of the main differences is the time horizon. So we deliberately try to focus on the shorter term because we link that it is easier to understand the uncertainty, especially if you think about energy transition in a wider context over a 5 to 10 year period, whereas it's very hard to understand all of the potential interactions over a sort of 20, 30, or 50-year period. So that's one difference. When it comes to top-down and bottom-up, we also grapple with a similar challenge in the sense that it's always difficult to reconcile top-down and bottom-up approaches, and that was also one of the drivers for us to come up with a new framework, because we couldn't find anything off the shelf that really is able to fully reconcile. And some of the problem Christopher alluded to, it was having very different results if you approach from bottom-up and top-down, similar to what we found as well, using different off-the-shelf solutions. So our ambition is to, with a framework, to achieve top-down, bottom-up consistency, but I can't really say we've quite got there yet. It's certainly where we're aiming to get to. On physical risks, I recognize that once we have sort of fully understood the picture in terms of the short-term patterns and how different locations are exposed to potential hazard in the short term, it will be important to extend the time horizon to understand potential significant or potential tipping points. And this is sort of in our list of next steps, which then will become a bit more similar to the type of analysis that Norges has done over a more extended time.
Okay. Right, that's really helpful. It's really helpful to compare and contrast the two approaches there. Caroline, you've been waiting really patiently, so thank you. I first got in touch with you about 2 years ago, I think, when you were piloting a narrative approach on a set of portfolios you managed, and then comparing and contrasting the results with a bottom-up scenario approach. Can you tell us a little bit more about what your findings were and what you have done since in this area?
Yeah, sure. And thanks very much for having us all on, because it's great to hear Mirko and Christopher as well talking about what they're doing. So I'm Caroline Cook. I work at Baillie Gifford. We're an equity manager. Right? So we manage concentrated portfolios of predominantly secondary market equities. So that's our sort of niche. It's a little bit different to the task and the portfolios in front of Mirko and Christopher. And I think that's one of the first things we had to recognize, and anyone starting out on this sort of scenario journey has to recognize, is what is the purpose? What is your what's your need as an institution around scenarios? So as I said, as an active manager of concentrated equity portfolios, it won't be surprising to learn that we found the quantitative based approach just didn't give us what we needed to be decision useful, for many of the same reasons that Mirko and Christopher have described, right? So we did look at some of the quant models out there. We did apply them to our portfolios, but they didn't make sense. And I think when you've got a concentrated active portfolio, you understand very well the 30 or 50, 60 companies you've got in there. And when someone gives you a model that says it's going to be plus or minus 1% in a vastly differing range of scenarios, you know that those aren't the right answers, and it doesn't really pick out what's happening at the individual company level. So you have a quantitative set where the modelling is weak, as already been described. It's insufficiently granular in terms of actual company impact, because they're reliant often on poor disclosure from companies. So you're trying to build a model which is already weak on top of a set of company disclosures which are insufficient for the task. You're then compounding the problem. But I think even more important than that, when you as a PM, you're given a set of numbers, a set of sort of to several decimal places about what's going to happen to your portfolio across different scenarios. It's very difficult to interact with that. And really, one of the most important things we've found in scenario work, whether using it for climate or other areas, is that the really critical thing is what you get out of it in terms of education, the discussion and the debate that it actually creates. And that's what gives you the decision usefulness. I think the other element to bring in that pushed us to doing it is that in equities, it's important to remember for that group as a particular asset class, we're dealing not only with the uncertainties of the scenarios themselves, in terms of what's going to happen around the transition, what's going to happen with physical risk, how that's going to interact with society and politics over time, but the companies themselves are also adapting and adaptable. So you've got a changing scenario and you've got changing companies. It's not like you have a fixed set of loan cash flows. You have companies whose equity returns, the cash flows that they generate, will be dependent on the decisions that they make as the world around them actually changes. So we needed to be able to capture that. So within a scenario, how are our companies going to respond? And then how do we think about them as investments? So, in brief, what we did is we had a look at the quant stuff, didn't meet our needs. So then we decided to try and work with some external academic partners to create a series of scenario narratives. It was important to us that we went outside for some help, because I think the other critical thing around scenarios is you don't want to repeat the views that you already have as an institution. You really want to have those challenged to come up with differentiated and challenging perspectives. So we worked with a couple of partners to create initially 3 scenarios, sort of 2 end members: hothouse world, climate failure, 1.5 degrees, a rapid transition, and then a disorderly transition, ultimately leading to success though in the middle. We've then built on that with several more. So we have several different versions of a disorderly transition now, but each of those are whole economy, whole society narratives, and they're purposely provocative. Because what we do once we have the narratives is we then take those into a workshop setting with our portfolio managers. So we ask them to read them, to respond to them, to debate them. And for them, not us, but for them, really, as a result of that sort of in engagement with the scenarios, to then pick out where they think the greatest sensitivities are, where they think the greatest risks and opportunities are, where they see clustering of risk and opportunity in the portfolio. So we're enabling the portfolio managers to think about it both at the individual stock level, so their stock choices, but then also at the level of actual portfolio construction. And then you can think about whether you as a portfolio manager want to tilt your portfolio towards one scenario being more likely than another, or whether you want to try and build in resilience because you actually don't want to take a bet on the scenario outcome. So once we've gone through that workshop, I'd say there are sort of 2 or 3 things which have been most useful in terms of learnings or findings have been, I think, and this is going to sound quite simple, but now we have a common language across the investment floor for understanding climate sensitivity. So if someone says, I think I've got this stock, it's a disorderly stock, people know what that means. Or it's a stock that's going to benefit from high policy and an orderly transition. Again, PMs can talk to each other and understand what that shorthand means across stocks. I think there's a much better appreciation of physical risk, as has been pointed out already. That's really missing from the quant models. And I think we as a sort of financial sector have really spent most of the last decade focusing on transition risk. Physical risk has been an afterthought. That's really changing now. But by getting on with the scenarios a couple of years ago, we were able to get on with that better understanding of physical risk. And that's really been good for our engagement with companies. It's put us on the front foot with those discussions with management, because we can't manage the companies, right? So it's a question of, are we best equipped to ask the questions? I think it's made us a little bit more aware of adaptation opportunities as stock choices for us. Where there are going to be companies who can make a positive contribution to adaptation over time. And then I think I'd also pick up one point that's come out of both Mirko and Christopher's presentations as well. It's enabled us to think about long-run trajectories for inflation, which is kind of an obvious thing to say now, but I think 2 years ago, we were all a bit too complacent about that. But it's really given us a way to think about how we might, the trade-off between the long-run deflationary impact of a lot of the new energy technologies we're seeing versus the long-run inflationary impact of a lot of the physical risk, and how might those two tensions play out. So that's been important in terms of portfolio construction. And then lastly, I think just really giving us an idea about what the enduring themes are. So even if the transition is slow, it's messy, one is fast, one is regionally diverse, there are a few key themes that we think will endure. One of those being electrification, some of the new technologies which have moved past the tipping point. So I think a really current example of that, for example, is solar in the US. There's been a lot of messy policy, more than messy policy going on in the States at the moment. But fundamentally, that is a technology we think has passed the tipping point. If the US wants more power, solar is going to have to endure, even in that environment. So it just helps us pick out those things that will continue on. So hopefully that's giving you a bit of an idea, but we can talk about it more.
Super. So, sorry, I was busy writing down some of those really tangible examples about how it has helped with the so what afterwards. With that, are you seeing much demand from your clients then on taking a new approach or adding to the current scenario approach? And I was really interested in your point around making sure that you understand that the companies are changing. So it really highlights the importance of aligning this work with different parts like stewardship. It comes back to one of those poll questions where no one said where the scenario was linked to other parts. And I think you've really highlighted it there.
Yeah, and I think that is a really important part of it, because obviously there's a regulatory requirement on us through TCFD to be doing this work. There's also a regulatory requirement on companies to be doing it. And interestingly, in some jurisdictions, and interestingly, the instruction given to companies is often to do this qualitatively. It's us in the financial sector being asked to do it quantitatively. And actually, we should all have been asked to start by thinking about it qualitatively. So, by taking this approach, we're already speaking the same kind of language as companies. And it enables us to go in and have a conversation with boards about, have you thought about this scenario? How do you think your business will respond? Because again, it's for shareholders, we're not managing the business. What we want to know, though, and what we want assurance about is the managers of the actual business are aware of the possibilities and the messiness of the world that they're confronting, and they're going to manage that as best they can for us as shareholders. But to go back to your point about, is there demand for it? I'd say yes and no. I think when we offer it and when we talk about it to our asset owner clients and to some of the consultants, it's really a lot of interest, really keen. And what we've actually been doing now is repeating the workshops we've been doing internally for our portfolio managers with some of our clients. So we've been out and seen run quite a few of these workshops for clients in the UK. Just had a couple of colleagues who've come back doing a sort of mini roadshow of them in Canada. So it's something that once people know it's there and available, are really keen to take part in. And so that sort of takes back to the know bit, which is, I think there is this sort of, people know it's something they need to do. They don't like the numbers as they are, but what do you do about it? So I think this is, it's again, why things like this are useful. It's just saying it's complicated for everybody, but, you can start fairly simple and make a difference.
Yeah. And I think your point about the quantitative versus the qualitative, I think everyone focused in on the quantitative because it was something you could be more comfortable with, because data is more of a comfortable dynamic to be working with. Christopher, on that thought though, on the getting comfortable with the qualitative nature of this, how have you, or are you starting to think about nature risk as part of this process? And what methodologies or frameworks are you using? Sorry.
Yeah, no, so absolutely. So this is obviously climate and nature is very interlinked, right? So it's a bit of a strange thing that these are separate topics, but this is the legacy of TCFD and now TNFD, and then this is now absolutely time to bring these things together. So we tend to, so there are a number of reasons for that, right? Nature risks are relevant for climate scenarios. So even if you're just focused on climate scenarios, if you omit effects on nature or the impact that nature has on climate change, then you're missing, your model is invariably missing something. So we tend to focus on human-induced warming, but obviously warming can also come from degradation of ecosystems and, which reduce the uptake of carbon and then release natural carbon stocks like the thawing of the permafrost, for example, or deforestation. So this could happen suddenly, and so tipping points are important in this context. And so if models don't capture this, then we might be disregarding a potential exponential warming effect. So that's one. The other is, of course, that climate change may also perpetuate natural resource scarcities. For example, water, agriculture, other commodities that lead to supply shocks and indeed are inflationary. So this could suppress further growth and also lead to other indirect effects with further economic consequences. And this is also intuitive, but it's also left out. And of course, there's a wide range of uncertainties here, but this is kind of if you have a globally diversified portfolio, at least these macro effects are as important as damages to individual companies. So what we have done is we've partnered with the University of Minnesota, a research group there that has basically an Earth economy model and has combined that with an international trade model to try to estimate how changes in ecosystem services might impact the GDP over time across different climate scenarios. So they capture both the interaction between climate and ecosystem services and the impact of that on the economy, looking at different GDP effects at different countries and also sectors. So in our first iteration, which we disclosed earlier this year, we took a scenario in which three ecosystem services, so crop pollination, timber provision, and marine fisheries, would collapse entirely by 2030. And we wanted to see what impact that might have on the economy. So it's a very short-term, extreme scenario. And there, the model basically looks at the direct effects on certain sectors. And what we found was about a 2% decline of global GDP, which might sound very, very little. Indeed, it is relative to the volatility in GDP generally. But with that, again, you have to then interpret the results based on what we know about what goes into the model. And so the model only looks at 3 ecosystem services out of a total of 18 identified in the literature. And of course, these 18 are highly interconnected. So it's problematic in itself to look at only 3 of them in isolation. It doesn't account for these indirect effects. So for example, what we did see was a huge impact on timber provision and agricultural commodities. And so while these are isolated in a kind of a global equity portfolio, if you will, there aren't that many companies that are directly exposed to this. The indirect exposure in terms of the economic output of certain countries and regions, employment and inflation are potentially significant, and we can expect these things to have significant impacts. I mean, we just looked at, say, volatility in the price of olive oil or cocoa or oranges in recent years. I mean, that has ripple effects, and if we have that kind of impact on other types of commodities that perhaps are more consequential to the economy, this would obviously have greater effects. So we're currently expanding the analysis to include more ecosystem services, but we think this is an important kind of supplementary analysis to the pure kind of physical risk climate work we're doing.
Fantastic. Thank you, Christopher. Just conscious of time, I'm going to have a few more questions before we open up to others. Mirko, I was wondering when we talk about the key industry challenges in ensuring that the wider economy is equipped and aware of the approaches needed to identify identify the systemic risks, and how this is then properly captured into investment decision-making processes. What are the key barriers? What are the key industry challenges do you see?
This is a very complex topic, multifaceted. I think one of the big challenges for me is the amount of uncertainty there is on the. If you think about the impact of alternative transition scenarios and the impact of physical risks, there is a lot of uncertainty. We have different frameworks that can help us navigate that uncertainty, but we can't remove the degree of uncertainty. So, and if we think about integrating these considerations into investment framework, that becomes a challenge. And many investment framework, many portfolio construction models are still very much grounded on historical data and historical experience, one way or another. Sometimes very mechanically, looking at historical volatility, for example, or looking at historical relationship when trying to come up with the fair value or the long-term trajectory of interest rates or equity multiples, etc. And the challenge when we think about the transition and the physical risk is that it's quite hard to find historical precedents. So you need to really come up with frameworks that are very much forward-looking, and if you are very quantitative, it is very difficult because they're not. It's hard to ground any quantitative model on history because there is very little history to guide you. So, and that's why what we've attempted to do at USS is blend some quantitative analysis with ultimate layer judgment. It is just impossible to purely base decision making on forward-looking dynamics that are so uncertain purely on quantitative models. So I think that's a huge challenge for the industry. It can be easier for more sophisticated investors to embrace this, but I can see, speaking to many of our peers, that it does pose a lot of challenges.
Yeah, and there doesn't seem to be a silver bullet for that. So it's more about, I suppose, leading on to the next steps. Well, Mirko, you mentioned that in your keynote, but addressing some of these challenges, is it a point of continuing to develop both the narrative scenario and using that alongside a bottom up and developing
Yes.
more?
Yeah, it's very much as I mentioned before, integrating top-down and bottom-up perspectives. It is refining the narratives. It is understanding in real time what narrative is becoming more or less likely, and really helping us be better equipped to integrate the output from the analysis into decision making.
Okay, thank you. And Christopher, same question about your next steps.
Yeah, no, I think initially, right, we recognized, and obviously, that this is a long-term problem, and so we needed to look at long-term timeframes, and then not least to capture the full range of risk, right, which particularly on the physical risk side are likely to materialize after the mid-century. So if you have short timeframes, then you might not capture the full risk. But then, of course, if you think of more practically, prevailing kind of investment horizons, the shorter time frames, being able to articulate what this means for a shorter time frame is key. So that we're going to explore that, and that's in line with other stress test scenarios that we've developed and quantified in other areas. So we have an annual stress test report that's public, where we each year select a number of stress tests that could impact the market, and around a set of scenarios and narratives, and we quantify those narratives, and then we publish the results. So this would be following a similar approach. We're going to integrate this more with our financial modeling more broadly, and we're also going to explore the possibility of polycrisis, just because we need to add a little more complexity, right? So it's very likely that if we expect these acute climate shocks to happen more frequently with greater intensity, then at some point they will happen in parallel with another economic shock. It could be a debt crisis, or it could be some a longer term kind of economic malaise that changes the conditions for the economy that the shock will enter into. And so that interplay between different types of crises is interesting to explore. And you could do that through narratives. And then finally, further development of this nature risk scenarios that I mentioned to capture more additional ecosystem services and potentially also the indirect losses to like what it means for the broader economy if you had price inflation in agricultural commodities or any kind of disruption in trade patterns. How will that kind of spread, if any? What are the interdependencies between different economies, particularly those economies where we're heavily invested that have very developed listed markets, and those economies that are most likely to have the largest negative effect? So these are low-income kind of agriculture-based economies that are most vulnerable and also most likely to be affected by these physical risks. So there's a lot of additional questions to explore.
Thank you. And Caroline, same question.
Yeah, no, thanks. Well, two things. One, we are working still, we're going around again on tying our qualitative work to our long-term return expectations, so linking them to our future macroeconomic indicators. So that's an ongoing process, and we are using an external panel to help us think that through. So rather than trying to put the scenario into a black box, we're trying to get experienced macroeconomists to think through the macroeconomic implications of the narratives that we have and then come up with indicators from that. So sort of qualitative approach to quant, if you like. And then the other thing we've spent a lot of time on this year is developing a new scenario, which we call max energy, max adaptation scenario. So, a large part of the energy complex likes to think, instead of thinking about this as a transition, they think about it in terms of energy addition, that will continue to, without climate policy, will continue to use fossil fuels for a long time. But generally that view of the world comes from the fossil fuel lobby. So at the same time that they encourage this sort of persistence of fossil fuels, they are pretty downbeat on new technologies. But what actually, if new technologies really do unlock significant new energy upside, so particularly around solar, for example, where we see the compounding and the advantages so great at the moment. So you could actually move into a situation where we actually have very large amounts of energy at a reasonable price or cost available. But the flip side of that is we're going to keep emissions higher for longer. There is going to be more physical damage. So what we've really tried to get into is, to what extent can that higher level of energy availability help us deal with some of these physical issues? So how much energy does it take to give us all sufficient cooling? How much energy does it take to give us sufficient desalinated water? And ultimately, moving out to the end point of our scenario, how much energy does it take to really start to get involved in geoengineering as the physical climate risks really start to compound? And so what's that sort of trade-off between high energy and that high adaptation need, and what sort of implications would that have for company opportunity? So it's that next round of narratives we're working on.
Fantastic. I just want to finish off with your thoughts on any kind of practical next steps or actions that you would give the audience today for implementing this approach. And can I start with Caroline, maybe with the pensions in the room, some suggestions on, what are the kind of questions or the next steps that you would suggest to them to find out more about this?
Yeah, I think the two things. One, decide what you want to do, right? So do you just want to get straight to an answer, or do you want to have sort of a discussion and debate? So it becomes part of an education process for asset allocation. So decide on the purpose of the task. What do you want? Just an output, or you want to get involved in the inputs? And then once you've made that decision, I think just as we weren't, don't be afraid to look externally for help. We've got three of us on the panel today who've done this kind of stuff. There are others out there who are doing it as well. And it's really helpful to get external perspectives in the room to challenge you on your understanding and the way you think about scenarios. So I think those would be the two things. What do you want it for? And then, look around to see who else is working on it.
Yeah, leverage what's out there already. Thank you. And Christopher?
Yeah, I would say that it's once, if you buy an off-the-shelf model and then with a high level of precision, number of decimal points, it's kind of tempting to just take those numbers, but it's important to understand, to kind of look under the hood to see what's there and to understand how those numbers were generated. So you have to approach this with healthy skepticism, and it doesn't mean that the models are wrong, but it just means that they are most of them are based on very strong assumptions. They have to be. They are projecting changes, 60 years ahead in time to think about what we would have thought about the world 60 years ago. It's you approach this with some humility, and then be open about the limitations. And at least that's what we've done in our reporting, is really be transparent about what the pros and cons of different approaches are, and how we use them and how we interpret the results, and then also engage with the people who manage those models, or to give feedback. I mean, we're all kind of in a field, in an emerging field, right, of climate scenario analysis applied to asset management, and so the more we kind of give feedback to each other, talk to each other, help each other develop these models and methods, I think the better for all of us.
Thank you, Christopher. And final word from you, Mirko, before we open up to the audience.
Yeah, so I think it's good to see that the pension regulator has endorsed the approach we've taken. We've seen on the blog they're mentioned specifically USS, and so the message I would give to other pension funds looking at climate scenario analysis is you don't necessarily need to choose off-the-shelf products or solutions. You can build something yourself, or you can leverage on some of the work that people like us have already done. The second thing is you don't need to focus on quantitative analysis and numbers only. I think it's much more important to think about narratives, and also it's very important to involve the investment teams, and to I think similar to Caroline, we also have workshops involving the investment team to help us develop narratives. So I think that's a really good way to ensure that this is not just a tick boxing exercise, it becomes a process that then really gets embedded into decision making.
Great, thank you, Mirko. And on that point around leveraging others, we are building the Accounting for Sustainability, are building as part of our toolkit that we do for chairs and trustees. We're building another guide around the scenario analysis, which will be short and sharp, which will be working with some of these experts and others on some of the most salient questions to ask your service providers, or what are the practical steps that you can take in-house. So that should be coming by this side of Christmas hopefully.